Hello everyone and welcome to a new video on our channel. Today we will explore a fascinating topic about the projected global economic growth for the years 2024, 2025, and 2026. Before we begin, we want to thank you for your continued support and remind you that you can find more interesting content on our channel. The dynamic chart you are about to see has been created based on the image now displayed on the screen. As always, the sources used for this analysis are cited at the bottom of the image to ensure the transparency and reliability of the data. This chart shows growth projections for three main categories: the global economy, advanced economies, and emerging and developing economies. What we are about to see is not only revealing but also provides valuable information for those seeking the best investment opportunities. Let's begin by analyzing the projections. The global economy, which represents the combined global performance, is expected to grow between 3.2% and 3.3% during the mentioned period. This moderate growth reflects a steady recovery after recent economic challenges. However, when we break down these figures, the differences between advanced and emerging economies become very evident. Advanced economies, such as the United States, Japan, Germany, and the United Kingdom, show a more limited growth projection, fluctuating between 1.7% and 1.9%. This behavior has several explanations. On the one hand, these economies have already reached high levels of development, which limits their growth potential. Additionally, economic cycles and current challenges, such as high interest rates and inflation, hinder faster expansion. While these economies offer stability, the return on investment can be lower compared to other alternatives. On the other hand, emerging and developing economies show a more optimistic outlook. They are projected to grow between 4.2% and 4.3% during 2024 to 2026. Positioning themselves as one of the most attractive categories for investors. These economies, which include countries like India, Brazil, Mexico, South Africa, and some in Southeast Asia, have several advantages. First, their development potential remains high due to the expansion of their domestic markets and the growth of their young populations. Second, they often have competitive labor costs and greater flexibility to adapt to global market needs. It is important to highlight that in the dynamic chart, we have included India as a clear representative of emerging economies, while China is not entirely in this category. This is because China has reached a level of development that places it at an intermediate point between emerging and advanced economies. Although it continues to grow at a remarkable rate, its economy faces structural challenges, such as growing debt and a weakened real estate sector, limiting its inclusion as a pure example of an emerging economy. In contrast, India is projected as one of the main drivers of global growth thanks to its economic reforms, the digitization of its economy, and an ever-expanding workforce. When we look at historical data, we find clear patterns that reinforce these projections. For example, over the past 2 decades, emerging economies have consistently outperformed advanced ones in terms of percentage growth. This is largely due to improvements in infrastructure, education, and openness to international trade. Countries like Vietnam and Bangladesh have achieved significant transformations in their economies thanks to a focus on manufacturing and exports. In the case of advanced economies, although they have a lower growth rate, they offer certain advantages for more conservative investors. The stability of these economies and their ability to withstand global crises make them safe options for those who prioritize preserving their capital over obtaining high returns. However, the strength of the dollar in recent years has posed certain challenges, especially for international investors. The appreciation of the dollar can make investments in developed markets more expensive and reduce relative returns when converted to other currencies. Returning to emerging economies, it is worth noting that they are also highly diverse. While some focus on raw material exports, others have developed robust technology sectors. For example, India has become a global leader in information technology services, while Brazil excels in agriculture and mining. This diversity means that investors can choose from a variety of sectors to diversify their portfolios. An important aspect to consider is how government policies influence these projections. In India, for example, reforms aimed at improving the investment climate, such as tax simplification and the promotion of startups, have significantly increased its appeal. Similarly, Southeast Asian countries like Indonesia and the Philippines are implementing policies to attract foreign investors and foster domestic growth. Of course, investing in emerging economies also involves risks. Financial market volatility, political uncertainty, and dependence on external factors such as commodity prices are some of the most common challenges. However, with an adequate strategy, these risks can be mitigated. For instance, investors can opt for investment funds or diversified ETFs that include a variety of countries and sectors. Historically, the success of emerging economies is also due to their adaptation to global trends. During the 2010s, countries like Malaysia and Thailand capitalized on the rise of electronic manufacturing, while in more recent times, India and Vietnam have led in the adoption of digital technologies. From an investment perspective, one of the main reasons to consider emerging economies is their demographics. Many of these nations have young populations that represent a growing workforce and an expanding consumer market. This contrasts with advanced economies, where population aging is beginning to slow economic growth. The middle class is also growing rapidly in emerging economies, driving demand for goods and services. This factor, combined with improvements in infrastructure and education, is creating a favorable environment for foreign investment. For example, the rise of e-commerce in India and South Africa is opening new opportunities for technology companies and retailers. Another relevant point is the role played by trade agreements and regional integration in the growth of these economies. Organizations like ASEAN and Mercosur have facilitated trade between member countries, strengthening local economies and increasing their competitiveness in the global market. These agreements not only promote trade but also attract international investors looking to take advantage of interconnected economies. Additionally, emerging economies are also leading in sustainability initiatives. Countries like Costa Rica and Uruguay have invested heavily in renewable energy, positioning themselves as global examples in the fight against climate change. These initiatives not only benefit the environment but also generate investment opportunities in sectors such as solar and wind energy. In conclusion, the global economic outlook for the coming years presents interesting opportunities, especially in emerging and developing economies. With projected growth higher than that of advanced economies and the global average, these regions offer investment potential that should not be overlooked. However, as always, it is essential to be cautious and consider the associated risks. Before we say goodbye, we invite you to watch our next video, where we will talk about why it is crucial to be cautious when investing today, especially considering the impact of a strong dollar on financial markets. This topic is vital for those seeking to protect and grow their wealth. Thank you for joining us on this journey. If you liked the content, don't forget to like, subscribe, and activate the notification bell so you don't miss any videos. See you in the next episode.